All right, great. Thank you very much for joining. So, this is our first session of a four-part session on our retirement boot camp. And I'll go through the overall session and the agenda for today in a second. But first, anything you hear today is general advice. Obviously, I don't know anything about you, so I can't offer personal advice. My email address is available. It's mark.lamonica1@morningstar.com. If you have any questions, just send those over and we will get started. So, today in this first session, we're going to focus on estimating retirement spending. And you can see the four sessions laid out here. And we're going to progressively go through the different points that we think are really important to think about for retirement. So whether you are on the cusp of retirement, whether you do have a longer time until retirement, all important. So we can kind of think of session one and session two as creating a plan for retirement. And then we're going to start dealing with some of the realities as you're transitioning into retirement and when you're in retirement in the last two sessions. So you can think of these first two sessions as really part one of this exercise. So that's the agenda for today. Won't go through everything because obviously we are going to cover it right now. But we do have two different learning objectives that we are going to try to walk through today that hopefully you should come out of this understanding a little bit better. The first is we're going to estimate your retirement spending for the first year of retirement. And this is really going to be used as a foundation to calculate the lump sum you need when you retire. And we'll get to that calculation in the second webinar, which will be next week. But we do need to establish that foundation today. We're also going to learn a little bit about the 4% rule. So the 4% rule is one of the most famous rules of thumb, we'll call it, in personal finance and retirement. And that 4% rule is something you hear a lot. It is known as a safe withdrawal rate. So we're going to go through the details of that. But really what we want is we want you to be able to come up with your own safe withdrawal rate. And we'll do that in next week's session as well. But today we want to understand what the 4% rule is so that we can adjust it based on your personal circumstances. And I do think that that's really important because there is no one size fits all retirement. It just doesn't work. And the goal of this entire bootcamp series is for you to create a personalized retirement plan. Most people don't do this, especially most people that do not use financial advisors. Instead, what people tend to do is they gravitate towards these, as I said, 4% rule of thumb, but also these overall industry standards and average super balances. And we'll go through both of those to try to understand if they're on track for retirement. But without actually going through and thinking about your retirement, you can't know that. So let's start with the ASFA retirement standard. So it is something we hear a lot about. And really what this represents is, or what it's supposed to represent the amount of spending that people need to generate from their portfolio in order to support themselves in retirement. And what they've done is they've divided it up. You can see in that matrix, divided it up between what they're considering a modest lifestyle and a comfortable lifestyle. And then, of course, they've divided it up between people who are single and then people who are a couple. And they publish these numbers. They do change them every year. They publish these numbers, and I guess if you have my reaction, you look at these numbers and you can either say that looks about right, that is way too little, potentially that's way too much in terms of what I need for retirement. But it is important to understand the drivers for those numbers, which I do also think makes them mostly irrelevant for people. And the first one is the assumption with these ASFA estimates are that the age pension will be available for anyone who goes into them. So the age pension, of course, is available for people that qualify. And the qualification is around an asset test. So basically excluding your home, and we'll spend more time talking about this in the transition to retirement webinar, but really excluding your home, what assets do you have in super, outside of super? So that could obviously be anything you have in your super, any investment accounts, any emergency fund or cash savings you have outside of super, and then any investment property you may own. So if you are below the amount, you qualify for the age pension, and there are tiers in there where you can get the full age pension or a partial age pension. But it does assume, so these spending numbers does assume that the age pension, that you qualify for the age pension. The second assumption, which I think is a big one, especially with some of the things going on in Australia, is it assumes you own your home outright. And I put a couple facts under there. So, of course, owning your home outright means that you own your home, number one, and you have paid off your mortgage. So you essentially have no housing costs other than upkeep and maintenance. But looking right now, 82% of retirees currently don't own a home. So that 18% is, of course, renting. That is likely going to change as housing prices have gone up. Homes are obviously less affordable, and we look at some of the younger generations, less people own their home. So it is likely that going forward into the future, less people enter retirement owning a home. The other thing is it assumes you've paid off your mortgage, of course. And if we look right now, 50% of 55-year-olds still have a mortgage. Now, 55 is obviously before the retirement age for most people. That mortgage balance could be huge. It could be something that they can pay off in the next couple of years. We don't have that data, obviously, for individual people. And the intention is to put yourself in this. But that will likely go up as well, just because people are buying homes later because they're more expensive. You have to save more for them. Interest rates are, of course, right now higher, which makes it harder to support just your mortgage, let alone prepay it. So it is very likely that both of these two measures will go down, that more people enter retirement if they own their home with a mortgage, potentially a still meaningful mortgage. And of course, more people enter without owning a home. And so once again, this detracts from the relevance of this benchmark data that we see. And then finally, it assumes you have no debt. So no commercial debt or no consumer debt outside of your home. So credit card debt, I guess still student loans, debt on a vehicle perhaps that you own. And right now, if we look at the baby boomer generation, the average baby boomer has $4,842 in debt. And once again, I think that it's likely that this will increase. Both people who enter retirement with debt and the balance on that debt. Of course, we've all heard about the cost of living crisis. A lot of people resort to debt, of course, based on just trying to keep up with inflation. So it's a benchmark. I don't think it's particularly relevant. And the whole point of this series is, of course, come up with your own plan rather than relying on the benchmark. And then we have average super balances. So these periodically get published. They're always very popular. And this is kind of a little bit of a check the box exercise, I think, for people. You go in there, you look at your age range, you look at your super balance, and you either think, great, I'm doing well, or, oh, I'm not doing well. Those are probably the people that don't open those articles. But once again, none of this shows, and your super balance, of course, has to support the spending that you envision for retirement. So the number is really not relevant. So if you leave more of that, but you have higher expectations for retirement, that doesn't mean anything. So once again, another benchmark that people use because they don't go through the process of figuring out what they actually need for retirement and that lump sum that they're trying to save towards, which is the purpose, to calculate it yourself, the purpose of these first two sessions. All right, so as I said, we're trying to calculate that lump sum, that super balance or balance outside of super, but the amount of money that you need to live the retirement that you want. And we're going to do two different things to calculate it. And we're going to do these over these first 2 weeks, so these first two webinars. The first one is calculate the acceptable annual income. Now, acceptable can mean many different things. Some people have visions of traveling all over the world when they're in retirement. Some people are just trying to get by, but that's the point. You need to personalize this. So we need to figure out how much income you need. What is your spending needs? What's your budget for retirement? And we're going to do that today going through the income replacement rate. So we'll go through that entire process. The second thing, as I talked about before, is how much can be safely withdrawn each year so that you don't run out of money prior to death. Now, I'll go through all the challenges of this, but mathematically, this is pretty simple. If we know our retirement budget, how much we want to have in that first year of retirement, and we have a safe withdrawal rate, you simply divide the amount of money you need in retirement by the safe withdrawal rate, and that calculates the lump sum needed for retirement. Now, there are a lot of nuances involved to come up with those numbers, but that's really the exercise we're going to go through in these first 2 weeks. Okay, so let's talk about the income replacement rate. So very simply, and there are multiple ways to do this, and I'll talk about both ways, but during our working lives, we become very preconditioned to thinking about our household finances and our budget in relation to a salary, because of course that makes sense. So whether you're paid fortnightly or monthly or anything else, your budget's based around your salary. A certain amount of money goes into your bank account, and you need to maintain a budget around that. And so I think keeping that same mindset makes sense. But in retirement, your expenses may be very different. And we'll go through some more specific factors, but here are some of the things that are going to change once you go into retirement. So number one, savings. So in retirement, typically people don't save money. You are saving money for retirement, among other things. But typically that savings may completely go away or go down significantly. And even if we just think about the employer mandated super contributions, so all of a sudden that can just shave off a certain percentage of your savings, because of course, if you're retired and not working, you will not be making those contributions. Taxes change significantly. Now, taxes are complicated. Taxes are very, very personal. I'll use a simplistic example here. The simplistic example is that when you move into retirement, you can place your super assets in a pension account and then draw on that pension account to fund your life. Now, there are rules around how much money can go into that pension account. We will talk about all of these during the transition to retirement. But simplistically, once super funds are in that pension account, you don't pay any taxes. You do not pay taxes on capital gains. If you sell something that's appreciated, you don't pay taxes on anything that, any income that's generated, whether that's dividends or whether that's cash income. You don't pay taxes when you pull money out. Of course, when we are working, we do pay taxes. So you can, at the very least, reduce the amount that you pay for taxes and potentially eliminate taxes completely. And then finally is lifestyle differences. So of course, when you are in retirement, your life can be very different. So obviously you don't have a job, you have lots of free time. Potentially that means you could spend more money, but also there could be some savings. So whether you are paying for commuting, others work associated costs that you may have. And in retirement, some people choose to change their lives. They may move somewhere else. They may downsize. There's lots of different options. You have to consider those lifestyle differences as well. So as I said before, the income replacement rate is a critical component of calculating the lump sum needed for retirement. And a lot of people tell me, especially people that have a long time frame until retirement, they say, how am I supposed to do this? I have no idea what my life will be like in 20 years, for example. And that is very true, but it is still a worthwhile exercise because it's better to have an estimate and adjust that as your life changes than just fly in the complete dark about retirement. Because the people that do not go through and think about retirement earlier in life are the people that wake up 1 or 2 years before they're going to retire and all of a sudden discover that they either have, in rare cases, saved way too much, or in most cases, can't fund the retirement that they want. So it's better to come up with an estimate, understanding that it may change, and adjust it as your life changes. So I think that's really, really critical as well, because if you don't have that goal, you don't have that target, that lump sum that you want, it's very difficult to make informed decisions about savings. So that could be extra contributions in the super, concessional or non-concessional contributions, investing, what is the asset allocation that you want in your portfolio? So the return that you need to try to achieve that outcome you want. It's very, very difficult to make those decisions if you don't have a goal, if you don't have that lump sum target for retirement. So whether you are 20 years old or whether you are 64 years old, I think it's really beneficial and important to go through this exercise. All right, so let's walk through this first part. We're going to estimate your income replacement rate. So there are tools that you can use, and I will say that the screenshot I took from paycalculator.com, which I'll explain in a second, just note that this is from 2021, 2022. We've recently had on July 1st changes in tax rates. So go in there and do it yourself. This is just illustrative. But go in and look at your salary and what your actual take-home pay is. Now, there's two different ways you can do it. You can use a tool like paycalculator.com, where you can go in and enter in your salary, and it will show you what's going to super, it'll show you what's going to tax. The other way, of course, that you can do this is you can go bottom up. You can look at your paycheck. If you're paid monthly, you can go see how much you are paid, multiply that by 12. That's your after-tax, after-super savings or paycheck, basically. The one nice thing about paycalculator.com is, especially if you are a long way away from retirement, is you can go in there and say, well, I do expect my salary to grow, and we'll talk about that. But, you know, if you are a 30-year-old sitting there and looking at this, your salary will hopefully grow and hopefully meaningfully grow over the rest of your career. So you can go in there and project at different income levels and see what those taxes are. Tax rates, of course, can always change, but this, once again, gives us an estimate that we can adjust if there are changes in tax rates. So what we can see here is we can see at a $100,000 salary that the income replacement rate's around 70%. So that's, once again, good news. So we're not trying to save for our entire pre-tax, pre-super salary. We already get to start with a 70% number that we can adjust. So what that means is that if your portfolio can replace 70% of your current salary, you can live the exact same lifestyle in retirement. Now, we're going to make adjustments to this, but that's really the starting point right there. As I said, depending upon how long you have until retirement, your salary could be very different. And so what I've done here is I've shown a screenshot from a tool that's on Morningstar Investor. It is behind a paywall, but you can also use any online financial calculator to do this as well. And what we can then do is estimate how much you think your salary will grow annually until you retire. So you can see on the screen, your current salary is the starting value. You put in a rate of growth per year. And I understand that you're not going to know this exactly, but you can put in that rate of growth per year. You put that in as a rate of return. So we're using a financial calculator to do this. And then you just put in the years until retirement. And it will show you, depending upon how much you make now, it'll show you what that projection is into the future. And we want to use that as part of our planning. One thing to note, in Australia and in a lot of countries, there is something called a graduated marginal tax rate, which basically means the more money you make, the higher the taxes you will pay on that portion of money above each threshold. Now, that's not great if your salary is growing and more taxes are taken out of it, but it does mean when we're looking at retirement that your replacement rate, because your taxes are more, your replacement rate actually goes down. And this is that scenario where I said that if you want to project a salary in the future, you can go and look at paycalculator.com, and it can actually calculate for you what your taxes will be, what your super will be based on that higher salary. So something that's important, particularly if you have a long time until retirement. If you only have a couple of years, then you can just assume your current salary and don't necessarily need to put that projection in. But yeah, something to think about. All right, so this next step is we are going to adjust your budget by any lifestyle differences. So I've listed a lot on here, but when you start thinking about retirement, start thinking about, okay, what are the things that will be different from an expense standpoint? Because we're looking at spending, how much spending you need as that first step of calculating the lump sum. So very simply, do you plan to move? Do you live in an expensive part of Australia and you are moving to a cheaper part of Australia or potentially overseas? So start thinking through that. What is your plan? Do you want to stay where you are? Well, then we don't need to make an adjustment. Do you want to move somewhere else that's cheaper? Well, then we can make an adjustment. Perhaps you don't need as much in retirement savings. One we talked about earlier, will you pay off your mortgage? And this, of course, is huge. One of the biggest expenses that everyone has is for housing, whether that's rent or a mortgage. But if you pay off your mortgage, of course, you no longer have that obligation. That can be a huge advantage for people going into retirement. So look at how long the term is of your mortgage compared to when you want to retire. If you're trying to pay your mortgage off early, that's another consideration. But think about it, that is still going to be an expense because that will make a huge difference. If you have to pay for housing, you need a significant amount more money to support your retirement lifestyle than if you don't. Think about spending patterns. Now, we're going to spend some time on spending patterns next week. But typically what happens, and we want to personalize this, typically what happens with retirement savings or retirement spending is that early in retirement, the spending is significantly higher. You are hopefully still in good health. You maybe have a backlog of travel that you might want to do. Maybe you're going and socializing more. You've removed this obligation of going to work, and people typically spend the most money in retirement right at the beginning. Then you tend to get into this phase where the spending drops meaningfully. Potentially, there are some health issues that make it more difficult to travel, maybe make it more difficult to go out, to eat, to socialize with friends. And so you typically see that spending go down. And then you often see a spike right at the end for end-of-life care. So medical expenses tend to go up. So remember that this spending is not smooth typically. But you need to think about in your personal circumstances, what are you planning on doing in retirement? And we're trying to create an ideal retirement here. So think about, are you going to want to travel a lot? Or is that something that doesn't interest you? And you don't actually think you're spending, that you will spend on things like that in retirement. There are costs, of course, associated with going to work. For some people, they can be very high. For some people, they can be very low. But commuting is a simple one, potentially wardrobes that you need for work. You can think about that. What is spending that you do now that's associated with work that would then go away? And then finally, a really important step. We talked about the age pension earlier. Do you have additional sources of income? Now, what we are trying to do here, and I keep saying we're trying to calculate this lump sum. Well, the lump sum is what you need, your portfolio needs to be in order to support a level of spending. But you may have other sources of income. So the age pension is a really good one to consider. Would you qualify for that? We'll go through it in transition to retirement. There's specific rules. But do you have other sources of income? Do you potentially own a investment property that's positively geared where you get income from that investment property? So think of every source of income you may have that is not supposed to come from your portfolio. So we're trying to separate those two. All right, I've got an example, and this is obviously a very simple example. So we have somebody who is making $100,000. They are paying $20,000, a little more in taxes. They are saving a little over $9,000 for super. So those both go away in retirement. We don't have to worry about those. So what are the current spending needs to support retirement? We've got that in there. That's 70,000. All right, we've removed those two figures. But this person is not retiring for 10 years. Their plan is to retire in 10 years. So what do? We take that current spending needs, that's $70,000, and we grow it by 4%. This person believes they can grow their salary by 4% per year for the next 10 years. That gives us 103,000. Now, they've gone through this exercise of reduced expenses, whatever it is. Maybe they're moving to a cheaper location, whatever these expenses may be, and they think $14,000 comes out of their budget. They think they're going to get $20,000 a year from the age pension. We remove that because we only care. It's still money you're going to spend, but we only care about what your portfolio needs. And that gives us a total. And basically, that's our first year total, that $69,000. So that's the exercise everyone should think about going through. Now, once again, if you are maybe a year from retirement, you can get a lot of precision into this number. If you're 25 years from retirement, maybe it's not as precise. We still want to go through that exercise. So what I would encourage everyone to do is spend a little bit of time. It wouldn't take that long to sit there and kind of come up with that number. Bring that into our second session next week, because then we'll take that number. We can calculate the lump sum. All right. Moving on to the 4% rule. As I said earlier, the 4% rule is one of the most famous rules in all of personal finance, and certainly for retirement. So I'm going to give a little history and background into the 4% rule because, well, I do think a lot of people have heard of it. I don't think people understand the details behind it and therefore don't understand the implications. So let's go through these. So the history is there was a financial planner in the US, and I believe it was in 1994 when he sat down and did this. And as a financial planner, a lot of people came to him and had this problem. How much do I need to save for retirement? Or how much spending can my portfolio support me during retirement? So he decided, okay, I'm going to come up with a method to calculate what that is, and then I'll have sort of a set number. And he went through this process, which I'll explain, and that is where the 4% withdrawal rate was the genesis of the 4% withdrawal rate. Now, what this is supposed to be is a safe withdrawal rate. It is supposed to protect you from running out of money before you die, which is a very important thing. Now, this is really, really challenging to do because we're all different. And so he had to make a bunch of assumptions. And you need to understand those assumptions to understand if they apply to you or if they don't. And this number is really important because depending upon your personal circumstances, if your safe withdrawal rate is 3%, you need a lot more money. If it's 5%, you need less money. So that's why this is such an important input into coming up with that retirement target. So here's what he did. He assumed that somebody had a portfolio of 50% shares and 50% bonds. Maybe you think that's crazy from an asset allocation perspective. Maybe you don't. But once again, that's the assumption that he made. There have been updates to this, but when he originally did it, because he's American, he just used US stock and bond returns. He went back and he looked at a period between 1926 and 1992. And he ran something called a Monte Carlo simulation. And the Monte Carlo simulation took every combination of share and bond returns and every possible order they could possibly be in. So it took all those real returns that occurred between 1926 and 92 and ran it through all these different scenario analysis. And I'll talk about why that's important in a second. But he had a couple other parameters. The first was he thought the best thing for retirees was to have a real or inflation-adjusted withdrawal rate. So one of the questions that I get all the time is, does the 4% rule mean that you take 4% out of your account balance every year? And the answer is no, it does not. 4% is taken out in the first year of retirement. And after that, the 4% goes away. Then you are adjusting the dollar sum you've taken out by inflation. Let me give an example if that doesn't make sense. Let's say you have $1 million. You retire, you say the 4% rules, my safe withdrawal rate. Million times 4% is $40,000. You're taking $40,000 out of your portfolio in that first year. Then that 4% goes away. You are adjusting the $40,000 by inflation every year. And that is going to maintain the same lifestyle, right? Goods and services go up, they cost more, but you take more out of the account from that dollar amount. So just because the math is very easy on this, let's say inflation was 10%, which obviously is not ideal. Take out $40,000 that first year. That second year, you take out $44,000. It doesn't matter what happens with your portfolio, and I'll explain why in a second. You're just upping that by inflation every year. The second thing that's really important is he defined retirement as 30 years. So his thinking was retirement age in the US is 65, 30 years gets you to 95. Most people will have died. Most, not all. So just remember that it's 30 years, that if you happen to live a very long time, your risk of running out of money goes up. The other reason why that 30 years is really important is because if you retire early, that's a problem. So most people will die by 95. If you retire at 50, most people that have made it that far don't die by 80. So it increases your risk of running out of money. Now, the problem that we're trying to solve here is he's trying to come up with a rule of thumb, or he did. He came up with a rule of thumb that's supposed to do what a rule of thumb does, cover most people. But what we don't know about the future is, of course, everything that's going to happen. The first thing we don't know is we don't know the levels of returns your portfolio will have. Just because you retire doesn't mean you are no longer invested. So that's really, really important. Higher returns means it's less likely you run out of money, of course, because your portfolio keeps growing. Lower returns make it more likely that you're going to run out of money. Second item is the unknown sequence of returns. It's not just the average return you earn, it is also the order of those returns. And I'll spend some time next week going through the math in this. But basically, what this means is that if you have the bad luck of retiring into a market that falls significantly, so your portfolio is falling a lot in value, right as you retire, that is a very big problem. It's a very big problem because not only is the market falling, and we hear all the time, and I say this all the time, you don't want to sell when the market is falling, right? Market's fallen significantly. That's actually when you want to buy, but you have to sell. You have to sell because you need money to pay for your life. And so when you combine a big market drop and selling things, pulling money out of your portfolio, it makes it, it reduces the longevity of that portfolio. Even if shares bounce back and the average return is still very, very strong, that fall at the beginning of retirement, I'll go through the math next week, that fall at the beginning of retirement is going to be very harmful. So you want to make sure that your money lasts, retire into a bull market when it keeps going up. Now, of course, that's unknowable. Anything can happen the day after you quit your job and walk out the door. But if you happen to retire into a bear market, it is a problem. We don't know inflation. Inflation's really important in this because, as I said before, every year the amount of money you take out of your portfolio is adjusted by inflation. So if inflation is higher, you're taking more money out of your portfolio. So that's an issue. Now, this is an area where we will have an opportunity next week to make adjustments for your situation. Because remember, the way that inflation is measured is that the ABS, the Australian Bureau of Statistics, has a consumer basket, which is supposed to represent what money or the percentage of every dollar that consumers spend in different categories. Well, you are not the average consumer. So, for instance, a very large part of that bucket and a very large part of what the average Australian spends goes to housing. Well, and we've seen huge increases in housing lately, right? Rents are going up a lot, mortgages are up a lot. But if you own your home outright, then all of a sudden that doesn't apply to you. So that's something that's really important to think about, your personal inflation rate. We'll do that next week when we personalize this. And then finally, as I said before, you don't know how long retirement will last. You could retire and drop dead in a year. You could live to 100. The challenge, of course, is there are continual medical advances. Remember, he did this in 1994. That was a long time ago. Lots of things have changed from a medical perspective. Your personal health obviously has an input into this as well. So that's also really important. Last point I wanted to make, the 4% rule, because I get this question all the time. The 4% rule is separate from the ATO mandated super withdrawal. So the Australian Tax Office tells you how much you must take out of super. You can take out more, but it tells you how much you can take out of super, and it does it by how old you are. And I think once you get past 65, you are taking out more than 4%. Now, the safe withdrawal rate is designed so that you don't run out of money. The ATO has very different motivations. They're basically trying to get money out of super because there's all these tax advantages, and they don't want people to use super as a vehicle to pass wealth on to heirs. So very different motivations. Don't confuse the two. The ATO is not sitting there looking at your personal circumstances saying you have to take 5% out of super. The ATO is just making a rule with different motivations. Taking money out of super is not ideal because there's so many tax advantages in super, but we're really talking about spending here. What can you spend? So you can take money out of super and put it into a bank account, a term deposit, invest it in the share market. You don't have to spend it. What we're looking at here is how much you can safely spend out of your portfolio, whether that portfolio is in super or not in super. So that's really what we're trying to calculate. All right, there's our disclaimer. That brings us to the end. So for each one of these, we will send out an email. The email will include, once we have it, it will include this recording. It will include a link to a website that will have this recording. It will have the ability to download the presentation I just went through, and it'll have some relevant articles on the topics we've covered where we've dived into them in a little more depth than those articles. So as always, I welcome any questions. You can send questions to mark.lamonica1@morningstar.com if you're not watching this live, and I'll get back to you in a couple of days. So thank you very much for joining. I really appreciate it. Hopefully you can join us next week for the second session where we're going to come up with that lump sum you need for retirement.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.